Hi, I'm Jeff Hibbeler, Senior Portfolio Manager with Essential Wealth Advisors. And today I'm bringing you an economic and market update following the April employment report. Expectations were again high coming into the April employment report, with estimates of near 1 million job gains following last month's similar gains. Wednesday's ADP report showed strong gains, and most business surveys also indicated another big month of hiring, although companies have been having difficulties filling open positions and finding candidates for them. Surprisingly, payroll growth came in well below expectations and even below the lowest Wall Street estimates. Jumping into the numbers, headline non-farm payrolls grew at 266,000 for the month, compared to an even 1 million estimate of economists. The 2-month net revision was another negative 78,000. The leisure and hospitality sectors posted a strong gain at over 300,000 and recouping some of the jobs lost in this sector that was most affected by the pandemic. Governments also gained about 50,000 jobs, and much of that was in local and state governments. However, most other sectors posted little gains or even lost jobs in the month. The temporary help sector and trade transport sectors were the biggest job losers in the month. The unemployment rate for April ticked up slightly to 6.1%, compared to estimates of a decline to 5.8%. Now, the details behind this weren't all bad. Employment in the household survey grew, but the labor force expanded even more, and that led to the increase in the unemployment rate. This was driven by an increase in the labor force participation rate to 61.7%, which was above estimates. While the labor force participation rate is still below pre-pandemic levels, it's encouraging that more people are re-engaging in the workforce and joining it. The more broadly based underemployment rate did in fact decline 0.3% to 10.4%. Looking at earnings, the average hourly earnings surprised to the upside in the month, rising 0.7%, and the year-over-year comparisons also rose slightly at 0.3%. The small year-over-year increase is due mainly to compositional factors that heavily skewed it, particularly early in the pandemic. Average weekly hours also ticked back up to its all-time high of 35 hours per week. The reasons for this morning's large miss will no likely be debated for weeks to come. Remote learning and some workers' health concerns are no doubt weighing on employment. However, continued generous unemployment benefits are likely contributing to constraining job growth. Business hiring surveys and innumerable anecdotes of restaurants and other business shortening hours, limiting service, or eliminating days open clearly indicate that these are constraining the supply side of the economy. As the current federal unemployment benefits package isn't set until Labor Day, it's likely many of these effects will remain throughout the summer. Today's report certainly won't cause the Federal Reserve to reevaluate its rates policy or asset purchases in the near future. Market reaction in treasuries was initially sharp, with the benchmark 10-year note trading down 10 basis points to roughly 1.46%. It has subsequently given back much of that gain, and after getting back to near pre-release levels, has settled in around 1.54%. S&P futures were higher before the jobs data release, and they've maintained that levels, and following the cash market open, they are trading at all-time highs again, near 42.25. Alas, sometimes bad news is good. Thank you for watching today. If you have any comments about our video or would like more information about our firm, please go to our website at essentialwealth.com. We'd love to hear from you.